Get ready. This is Crypto Talk with Mike Willis in 3, 2, 1.
Hello and welcome to Crypto Talk. I'm your host, Mike Willis. For those of you that don't know me, I spent 30 years as a trader and portfolio manager on Wall Street. And in 2018, I became a Bitcoiner. Each week, we look at crypto, the markets, and news that actually matters. First up, let's pull up the Bitcoin chart and see where we stand for the week. As you can see, we're still off hard in the last 2 weeks from our 30 to 35% pop off the bottom. Back in October, we hit 126,000 on Bitcoin, gave back 50% of that, then rallied off the bottom on regulatory clarity and some other positive news that was in the market, but more recently gave it all back. So I continue to believe that what we're seeing is we're tracking the 2022 crypto winter. This time around, it's happening a little quicker, so I'm not expecting the bottom length that we saw from the crypto 2022 crypto winter. So, but what I'd like to say, there's a lot of charts on the internet right now talking about a 365-day top to bottom and a 1,000 and change bottom to top cycle that's never been broken to the day. And let me just say that when you look at a lot of those charts, there's a logarithmic scale on the left-hand side. And basically, a log scale can enable you to control the data in a way where you can pick out patterns that aren't necessarily there. And they're there when you back model the charts, but they're not there on a normal price volume chart. So keep that in mind. There are definitely patterns. I do think we're synced up with 2022's crypto winter to some extent. But I don't think you can take it down to the day like this 4-year cycle chart that's circulating right now on the internet. Now let's zoom in on the 7 key data metrics for the week. Our price, we're sitting at $61,000 to $62,000 on Bitcoin, 1.2 trillion. Bitcoin dominance has risen from 57% to 59%. That means that the other crypto altcoins are underperforming Bitcoin. That means they're down even more. Daily volume of Bitcoin last 24 hours, 35 billion, still very strong. 628,000 Bitcoin transactions, and the average transaction was $64. I thought that was pretty good. Or the mean. I apologize. It's actually the mean transaction was $64. So that means right in the middle. If you take out the top ones and the bottom ones, the trades happening right in the transactions in the middle are right around $64. Pretty good if you're talking about a cryptocurrency that's used for buying and selling things. Sats per US dollar, we're running at 1,600. Parity would be there's 100 million sats per Bitcoin, and right now it's 1,600 sats per US dollar. The fee per block is running about 3 sats per transaction, so it's not per block actually. It's the sats, 3 sats per transaction. It's what it's running, which is very low friction, and it means Bitcoin's working. Money supply, we've minted 20 million of the 21 million coins. We're always going to talk about that because that is the absolute scarcity of Bitcoin is the core principle number 1. All right, that's the Bitcoin picture for this week. Now let's get into the news. But before we get into that, in my 30 years of trading, I can tell you the headlines are constantly changing. What you have to have is an investment strategy that works over the long term. I always like to ask, what's your crypto plan? Because most people simply don't have one. So keep that in the back of your mind as we look over the news for this week. Long-term matters, short-term, not as much. In summary, this article says that Bitcoin has just had its worst week since FTX, and we all remember that. Down nearly 20% in the last 7 days. We're all feeling the pain. But there's a specific data metric that has called every market bottom in Bitcoin's history. And we just crossed that threshold again in the last couple of days. So let's jump into the article. Every time this Bitcoin metric crosses this level, the market bottom, Bitcoin closed the week of June 5th with nearly a 20% decline, its sharpest single week drop since the FTX collapse in November of 22. But this on-chain analyst is pushing back against the prevailing fear, arguing that the market is approaching a major macro accumulation cycle rather than the beginning of a deeper structural breakdown. So 20% in a week, the headlines called it a meltdown. This on-chain data is calling it something different, and I like his analysis of this. So this analyst talks about how there's a convergence of on-chain metrics that have historically accompanied market bottoms rather than preceded further selling. Bitcoin's decline to 59,000, its lowest level since 2024. Think about that. We're in 2026. We're at the same levels Bitcoin was at in 2024. I don't think there's any Bitcoiner out there that predicted this. He's saying that this pullback has flushed out what he describes as over-leveraged premiums across the board. And that kind of forced deleveraging, he argues, is typically what creates the conditions for a genuine bottom rather than a temporary bounce. I actually love this because there's way too many people using leverage in the market. They're getting flushed out. When you get rid of the leverage, you can continue the cycle. There's a lot of noise about Saylor in the market, his leverage, but it's not just Saylor. It's investors in general. They get way too bullish on their positions and think that they can go into stock options or leverage them with margin in other ways. So this analyst is saying the deleveraging is important to pinpointing a bottom. It's painful in the moment, but it's exactly what clears the way for the new cycle. The Bitcoin metrics behind the call, 2 data points sit at the center of Martinez's analysis. The first is long-term holder behavior. During the recent downsizing, long-term investors distributed more than $3.25 billion in spot Bitcoin, temporarily pushing exchange reserves higher and increasing potential short-term selling pressure. That distribution is consistent with what historically marked the final phase of a supply absorption before accumulation begins. So 3.2 in distribution, that's a significant selling number. Historically, it's been the final act before the smart money starts its buying. The second is supply held at a loss. Bitcoin's drop to 59,000 pushed more than 10.5 million Bitcoin into an underwater position. According to Martinez's post, every previous instance where the supply in loss metric crossed the 10 million threshold has accurately timed macro bottoms in prior cycle, a signal he considers one of the most reliable indicators available. 10 million coins crossed into the red. Every single time that's happened, it's been a bottom. Every single time. So where the bottom could land. Rather than calling a specific price floor, Martinez identified 2 accumulation zones based on his band analysis. The ratio of Bitcoin's market value to its realized value. The most reliable accumulation windows historically appear when these bands settle between 1 and 0.8 bands, which currently correspond to approximately $53,000 to $43,000 per Bitcoin per his analysis. He's also tracking 3 key moving averages as structural reference points. The 200-week simple moving average, which is at 62,000, right about where we are now, and the 300-week $55,000 and 400-week $42,005. So that range is 43,000 to 54,000. It's not a prediction, but it is a historical band that has proved reliable. And these bands have been great guidelines during the past cycles. Another analyst, Benjamin Cowan, separately echoed this assessment, telling his audience that investor psychology is approaching the territory historically associated with major cycle bottoms, a phase he estimates could extend through quarter 3 and potentially into October. Two analysts, same conclusion. The bottom isn't an event, it's a season, and that season runs through Q3, potentially hitting October. So when more than 10 million Bitcoin are underwater at once, that's historically been the signal, not to sell, but to buy. So what that means is where Bitcoin is currently trading right now, over 10 million coins are underneath that threshold. So they would lose money if they sold Bitcoin. Every time that's happened in the past, it's been a buy signal, not a sell signal. So long-term holders sold into this dip. They exited their hard-fought positions, but the fundamentals haven't changed. In fact, they've only strengthened. And the analog to digital transition is not stopping just because the price dropped. And this is where hodlers have historically been rewarded for staying in the game. So keep those diamond hands. So let's move to article number 2. In summary, article number 2 talks about how Bitcoin is hovering near 61,000 and demand just hit one of its weakest readings in years, a level only seen 3 times since 2019. There's all kinds of reason for this liquidity dry up. You have everyone's talking about the new IPOs. You have SpaceX. You have Claude. These IPOs and people that chase price and returns, they're seeing these other vertical spikes like in the semiconductor chip charts. And they're recognizing, hey, we can be making money over here, over there, and our money over here is just losing money. So they are exiting Bitcoin, and that's what we're seeing. And here's the part the headlines aren't telling you about. The last 2 times this signal fired, prices didn't bottom, they kept going. Before you call this turn, you need to hear what the data is actually saying. So this article talks about how the Bitcoin rally has a problem. The demand is drying up. Bitcoin may need to climb back above 65,000 before any meaningful recovery can take hold. But getting there looks harder by the day. 65,000 isn't the target, it's the gate. And right now, Bitcoin can't get through it. This market analyst talks about a solid break past the level, the 65,000 level, could open up a door to a rally towards $72,000 to $74,000 range. Yet the broader demand picture suggests that that kind of move is far from guaranteed. And I would say it's not close quite yet. 72,000 to 74,000 is on the table. If Bitcoin can break through that 65,000 level, but the demand says it won't. So why the numbers look ugly right now? The 30-day combined growth of spot and potential futures demand has fallen to around 650,000 BTC, a reading that has appeared only 3 times since 2019. 3 times in 7 years. That's not common. Every time it's hit, something ugly followed. Crypto quant analyst Moreno flagged the figure as a sign that the market has entered one of its weakest demand phases in years, with both regular buying and derivatives exposure falling at the same time. That means fewer buyers are able to absorb any fresh selling pressure. So the spot buyers are gone, the derivative exposure is flushing out, and there's nobody there left to catch the knife. So what history actually shows, the 650,000 BTC demand level, it historically has not marked the market bottom. Based on Moreno's analysis, it has tended to mark the beginning of a difficult stretch rather than the end of one. And if you remember back to our chart, if we are tracking the crypto winter of 2022, which I believe we are, we go through a long churning base period. And that's what's hinted at right now by Moreno. The first incident came in December 2019 when Bitcoin was trading near 6,500 and demand conditions were already deteriorating ahead of the COVID-19 market crash. The demand indicator hit extreme contraction before prices collapsed further in March 2020, eventually bottoming near 3,800. So in 2019, Bitcoin was at 6,500, demand collapsed, COVID hit, the price got cut in half again, and the indicator called it first. This indicator did. A second instance appeared in January 22 when Bitcoin had already fallen from its then record 69,000 to around 32,000. Demand recovered in the following weeks and prices rebounded into March, but the recovery didn't last. So in 2022, demand bounced, price bounced into March, then it completely fell apart. Again, indicating we're not at the bottom yet. So the difficult phase ahead. Moreno believes the current setup looks more like a start of a final cleansing phase than a confirmed turning point. He expects a period of heightened volatility before the market settles into a prolonged stretch of sideways trading with low participation. Heightened volatility into prolonged sideways periods with nobody trading, nobody buying, liquidity going to other shiny objects that are in the market right now. That doesn't show recovery. That shows a little bit of purgatory coming for us. That kind of stagnation, he argues, might prove harder on investors than the price drop itself. For his part, he called the recent sell-off largely irrational, though he acknowledged Bitcoin remains pinned below 65,000 level that once served as support and has now become resistance. Sideways is harder than a crash. A crash ends, stagnation just grinds you down. So 650,000 Bitcoin in a 30-day demand cycle isn't a soft slowdown. That's both spot buyers and derivative exposure disappearing at the same time, for all the reasons we've talked about. And history says this signal marks the start of a difficult stretch, not the end of one. The analog to digital transition is still intact. The disciplined investor knows the difference between a bounce and a bottom, and right now the data isn't calling for a bottom. Article number 3. In summary, this article talks about Bitcoin holding the $60,000 level last week, but barely. And the technical picture underneath that bounce isn't pretty. 4 separate on-chain models, production cost, realized price, the moving bands, and a bear flag all point to the same level, $50,000. That's not one analyst's guess. That's 4 independent frameworks converging on the same number. Bitcoin bottom, these 4 charts hint at BTC price dropping to $50,000. A $50,000 price Bitcoin target remained in play despite Bitcoin maintaining above 60K support for now, as multiple indicators warn the bottom may not be in. Bitcoin bulls successfully defended the $60,000 psychological support during the last week when it pulled back 13%, and since then, we've seen it hold above the $60,000 level. Here's the chart for that. However, the rebound has not fully erased any of the downside risks. However, the rebound has not fully erased downside risks, with some traders warning that a deeper breakdown remains possible as the U.S.-Iran tensions and fading rate cut expectations weigh on risk appetite. So U.S.-Iran tensions, we all know what announcements were made in the last couple of days. We're bracing for another attack. There's fading rate cut hope and 2 macro headwinds that have nothing to do with Bitcoin fundamentals and everything to do with where money flows. Moving along on this article, several Bitcoin valuation and technical indicators now support that scenario, suggesting BTC could still revisit 50,000 or lower in the coming weeks. So not just one model, not just one analyst, but multiple independent frameworks pointing at the same number. Our key takeaways here is Bitcoin trades near its average production cost of 62,000, but risk dropping toward its lower electrical costs of 50,000. These are kind of neat metrics here. The cost of mining a Bitcoin right now is around $62,000, which is exactly where it's trading. So a lot of technical and fundamental chartists will take a look at that level, and they've been able to successfully navigate some patterns around that. If you just take the electrical costs of mining a Bitcoin, right now it costs $50,000 just for the electricity to mine one Bitcoin. Think about that for a second. So when you're mining gold and you can pull gold out of the ground and sell it for a couple $1,000s an ounce, there's a certain cost to pulling that gold out of the ground. Well, there's no different with Bitcoin. Bitcoin costs $50,000 in electricity just to mine one Bitcoin. and 62,000 once you factored in the other costs of the company. That's that threshold, and we're sitting right at that floor right now. So breaking even means no margin. No margin means for sellers, this is where mining operations start making the hard decisions. One of the key warning signals comes from the Bitcoin production cost model, which compares BTC's market price with the estimated average cost of mining one Bitcoin. That model shows Bitcoin's trading near its production cost of around 62,000. That means miners are on average close to breaking even at current levels. This level has historically acted as an important long-term value zone. During previous bear market corrections, Bitcoin often found strong demand when the price fell into the band between production costs and the lower electrical cost estimate. So every time Bitcoin has entered this band between production cost and electrical costs, buyers have shown up. Historically, the last line of defense before capitulation, according to this analyst. In other words, BTC is already testing the upper end of a major miner cost support zone. If sellers push the price decisively below the current production cost area, the next major valuation floor could sit near the electrical cost level of $50,000. So that's not a round number, that's an actual cost of electricity to mine one Bitcoin. And below that, every miner is operating at a loss. So it's a big deal. Moving forward, BTC realized price indicator reveals an even lower bottom of 37,500. So Bitcoin's realized price is the average cost basis of all BTC holders. So all BTC holders, the average cost is currently at $53,600. So as we talked about in the last article, that's about $10,000 from where we're sitting right now. Historically, Bitcoin has not formed a major cycle bottom without first trading below the realized price. And Bitcoin fell about 58% below realized price in 2011, 49% in 2015, 47% in 2018, and 34% in 2022. So every major market bottom came after Bitcoin traded below its realized price in 2011, 15, 18, and 22. Every single one, there weren't any exceptions. The last chart shows the bands, and we looked at these on the last article, but again, indicating a possible retracement to 50,000. So what does this mean? When miners are breaking even and Bitcoin has not spent any days below its realized price this entire cycle, then you're not at a bottom. You're at the beginning of this clearing phase. In 2022, Bitcoin spent 179 days below the realized price before it found its floor. This cycle, the count is still at zero. The analog to digital transition is still intact, but the market still has work to do before price puts in its bottom. So you have to be patient. Position investors have historically done well staying in through this phase, but it's not easy. Those are the stories on my radar this week. Now let's take a look at some numbers. I like to look at TradFi versus DeFi. Keep in mind, anything that's happening in the traditional markets will influence crypto. We've seen a bifurcation of the two markets for the first time in a long time. So let's pull up the S&P and get a read on what's happening in the traditional markets. For the last week, the S&P was down 3%, flat for the month, still up a solid 28% for the trailing 12 months. And whereas Bitcoin was down 8% for the week, down 23% for the month, down 43% for the year. And that's creating a TradFi DeFi spread, the delta of 71%. So again, let me explain what that means. That means if your friend just owns TradFi and happens to just be in the S&P 500, they're up 28%. And let's say you just happen to own 100% Bitcoin or cryptos, even down more than Bitcoin. The spread between you and your buddy is about 70%, and that's a wide spread. I mean, think if you had $100,000. 70% is $70,000, a $70,000 difference between your portfolio and theirs. So that's the macro picture for this week. Now let's wrap it up. So 30 years on Wall Street has taught me a lot of things. And here's what this past week reminded me of. Right now, more than 10 million Bitcoin are underwater. Every time that's happened historically, it's been a buy signal, not a sell signal. Selling has been strong, and there's 4 independent models that are pointing to a possible break under $50,000. And I agree with that. We're all uncomfortable, but this is part of playing the long game. So hard money is under pressure, but the supply hasn't changed because price has dropped. 21 million coins decided in 2009, and that's non-negotiable. So the people selling right now aren't responding to the fundamentals. They're responding to price. There's a big difference. This is where having a long-term plan gets tested. It's not in the rallies, it's when the markets crash. So as hodlers who've been here long enough to know that the tell isn't the price, the real signal is the fundamentals, and the code hasn't changed. It's saying the same thing it's said since 2009. And on that note, we are wrapped for this week. I'm Mike Willis, and remember to keep one eye on Wall Street and 2 on crypto.
That's Crypto Talk with Mike Willis. We'll see you next time.